Welcome to this episode of DMH Stallard's Private Wealth Podcast. I am Ingrid McLeave, a corporate tax and private client partner at DMH Stallard, and I'm joined today by Jade Swanston, Chief Revenue Officer at Advanta Wealth, Danielle Ford, Partner and Head of Tax Disputes and Resolutions at Hayes Mack, and her colleague Graham Privet, a partner in their private client team. Welcome to you all. We are recording this episode on the 4th of December, 8 days after Rachel Reeves' 26th of November budget. Much of the detail has been covered in various news outlets in depth. The Bank of England, among others, has suggested that the prolonged speculation and leaky nature of the run-up to the Chancellor Rachel Reeves' November 2025 budget had several negative impacts on the UK economy, primarily by increasing uncertainty, which caused businesses and consumers to delay investment and spending decisions, thereby dampening economic growth in the run-up to the budget. We're asking today, can the budget turn the economy round? Today, we thought we would take more of a bird's eye view and look at the overall ways of thinking about the budget, how it has affected businesses versus how it has affected individuals, the positives and the negatives in the budget. To try and answer the questions, what does the budget actually mean for people? How should different interest groups think about it? As you can see, we've got quite a lot to get through. I would like to introduce my first guest, Graham Privet from Hayes Mack. Welcome, Graham.
Thank you, Ingrid. Lovely to be here.
I've got a question for you. Was it really a growth budget for entrepreneurs and businesses? Who do you think were the winners and losers in this budget?
So 8 days later, I see the budget very much as a mixed bag of some surprising winners and some surprising losers. So a lot of this will depend on which class of individual you fall in and what type of business you run as well. So dealing with the growth part, there's some very positive parts of the budget that the Chancellor should be applauded for. So first one is around EMI changes. So for growth type businesses, moving the limit for the size of the business up from 30 million to 120 million, which has been a constant aggravation to businesses that grow up to a certain size and then say, when we want to go again, so generally around Series C, that they struggle to get the incentivization from the staff element to hire key key individuals for that growth. So my expectation is that's going to be received very positively. Equally, on the EIS side as well, for angel type investors, that threshold increasing up to 30 million is very, very helpful for them as well, and will attract more capital into growing businesses. So if you're a growing business, very positive. If you're an established business and bricks and mortar business, it's a bit more of a mixed bag. The Chancellor talked about business rates. That at the moment is a wait and see, and let's see to see exactly whether, if you're in a business that she raised in relation to hospitality, retail, leisure, that your business rates go down. So mixed bag from that perspective. And then in relation to the personal tax perspective, so the big key income tax change was there was no across the board income tax increase that we heard mooted across the summer. However, there are 2% increases to some savings income and to dividend income that we'll cover later on in the discussion. Again, not necessary to come into force immediately, coming across 2 years to do that. The other important part, particularly at the middle classes, is really the fiscal drag. So that is keeping allowances and thresholds at the same level and allowing inflation to bring people that were, for example, in basic rate into higher rates of taxation just by the effluxion of time, rather than them earning considerably more than they did beforehand. As I said, a lot of these changes come into force later on, and the spending is very much up front, described by the New Statesman as the Klarna budget. I know Other retail opportunities are available if you want to buy now and pay later. However, it is clear that certainly when it comes to the markets, I think they've generally accepted it quite well, and therefore we're not expecting large swathes of this budget to end up being rewritten as they did perhaps under Truss and Kwarteng. As we will get into, I think this budget ended up being a little bit more low key than we expected, and there are still some big issues kicking around in terms of the government's ability to keep balancing the national books and potentially paying down some of the large debt that we've accrued as a country during COVID. Also, on the personal tax side, we now have what I would describe as a new tax, so the high value council tax surcharge or mansion tax, and that comes in from 2028, but there's going to be a valuation process in 2026, and we wait for all of that detail. I think that's going to be it's going to have an interesting effect on the housing market in the UK. It's not set at a level that's probably going to make huge amounts of difference given a lot of the other expenditure when you come to buy or sell a house. So we wait for some more detail around that. And then the last point that we'll get into, I think, in the discussion is around inheritance tax. So the big announcement was like October 2024 in relation to APR and BPR, agricultural property relief and business property relief. There was a small concession that the industry had been calling for, which was to allow the transferability of both the new 1 million exemption from husband to wife or vice versa, or civil partners, which clearly was a mistake or a missing part of the original proposals. So a real mixed bag across the piece.
Thank you, Graham. I'd like to turn to Jade now. Jade, hi. What are your key takeaways regarding the changes to pensions in the budget and how they will affect individuals going forward?
Yes, thanks, Ingrid. And firstly, just so that I can talk freely with you today, let me get my risk warnings covered. Anything that I do say shouldn't be considered advice. As a firm, we don't advise on tax at Advanta Wealth, but there are sufficient people on this call for you to refer to. And for when I inevitably end up talking about pensions and investments, those can go up as well as down in value, and sometimes you can get back less than you started with. So, straight into pensions, then, Ingrid. I think we, in some ways, were surprised that after the previous large changes that were announced to the way in which pensions were going to form part of an individual's estate for inheritance tax, we saw another change to the way in which individuals can put money into a pension and be given relief on those contributions. Now, in the UK, I think it's widely recognised that retirement continues to be underfunded. So to see that there were further restrictions, in a way, on the tax relief given to individuals was for some a surprising move, despite the fact that the news had been announced or leaked before the budget. So effectively, what is going to happen is those that are making pension contributions through salary sacrifice, which has always been a very tax efficient way of placing money into a pension, because not only do you make savings on the income tax, but you also save on the national insurance. There is now going to be an introduction in a number of years' time, but of a £2,000 limit to those national insurance savings. Now, interestingly, when we look at the £2,000 limit, this actually kicks in pretty much at the auto enrolment limit that individuals are required to make contributions to pensions at. So in the UK, the Office for National Statistics estimates that the average UK salary is just under £40,000. That auto enrolment limit kicks in at 5%. It doesn't take that much of a maths degree to make 5% of £40,000 to £2,000, which is this national insurance limit saving on pension contributions. So whilst we already have a cap on the amount in which an individual can contribute to a pension each year through the annual allowance, which for all intents and purposes, avoids those large pension contributions being made into pensions each year, we now have a position where effectively anybody earning just a little bit more than the UK average and contributing that auto-enrolment 5% that's been set out will be limited to the amount of national insurance savings that they are making. Which, when we consider, as I've said, that retirement is underfunded, it's one of those things that may put individuals off making more generous pension contributions as we roll forward. However, I think it's still important to highlight the fact that actually these changes don't come in immediately. So whilst we have the ability to contribute up to £60,000 per year for those not using their allowances elsewhere, individuals really ought to be looking at whether they can maximise these national insurance savings between now and when the changes come into place. And for any employers that are listening who are considering whether their pension schemes are set up on a salary sacrifice basis, again, there is still significant opportunity in the coming tax years to make savings that will inevitably be beneficial to both employer and individual. But I think, as Graham was mentioning, we were probably expecting a few more changes to the world of pensions that didn't come to fruition. Things like tax-free cash limits changing, that they didn't come into play. So I do still think that the key change to pensions in not just this budget, but the budgets that Rachel Reeves has delivered so far will certainly be the significant changes that were previously announced to the way in which pensions will now fall into individuals' inheritance tax and their estate. That, for me, still remains the key planning area for individuals to tackle between now and April 2027. And I think those individuals that are most impacted are likely to be those who are almost expecting a double impact from the fact that they have large pensions built up, but of course may also be business owners. And we've heard in previous budgets about those changes to the way in which business relief is going to be granted. So we will have individuals out there that, as of April 26, will have their business assets subject to inheritance tax, and then April 2027, their pension subject to inheritance tax. And for some, that's going to create a significant change to the way in which they were viewing their estate, and ultimately the way in which their beneficiaries were going to inherit money. So for us, a lot of work to be done between now and April 2027 on the decumulation side, and making sure that those plans for individuals' estates remain appropriate. But I think this is going to see a bit of a sea change in the way in which people treat their pension and the way in which they choose to fund their retirement. So for anybody who is in retirement and drawing an income from their pension, it's definitely time to review where you're taking income from and how that is ultimately structured to ensure that it still remains appropriate given the pending changes that are coming down the track. And so, Ingrid, what planning can people consider then from a legal perspective?
Well, we've discussed both you, Jade, and Graham have touched on business property and agricultural property. These are reliefs for inheritance tax. Historically, they gave 100% tax relief by applying a 0% inheritance tax rate on all qualifying business and or agricultural assets without a cap, provided the owner had owned them for a minimum of 2 years. In the October 2024 budget, Rachel Reeves capped the combined relief to 1 million per person with effect from the 6th of April 2026. And at that time, the relief was not made transferable between spouses. Therefore, a number of people affected by this cap transferred a proportion of their qualifying business and farming assets to their spouse or civil partner, so that they each had the benefit of a separate £1 million IHT relief. They did this under the no gains, no loss rules for capital gains tax purposes. A gift is a deemed disposal and would normally trigger capital gain tax charge on the increase in value. But the no gain, no loss means that you can transfer between spouses and civil partners without triggering that gain. So it's in effect, it's a deferral mechanism. The spouse or civil partner will take on the base cost of the spouse that has made the gift to them. They then changed their will, taking their wives or husbands, civil partners out of their wills in respect of their business assets and farming assets, so that it went directly to the children, because under the 2024 budget, the relief was not transferable. This budget has made the relief transferable as between spouses and civil partner. So some individuals may now wish to unravel those arrangements and potentially leave their farm business assets to their spouse civil partner, that rather than to their children who do not wish to get involved in the business. This would only be applicable, obviously, if the business was worth under 1 million. If it's worth over 1 million, then you will need two reliefs up to 2 million. So you'd want to carry on with the gifts to the spouse civil partner so that you've got a £2 million relief rather than just the 1 million. Now, the other planning opportunity is that obviously we have until the 6th of April 2026 to gift, transfer to other family members, to a trust, or to consider incorporation of the farm or business, subject to obviously examination of SDLT issues, to multiply the number of tax reliefs available, because every family member will have their own inheritance tax cap. Farms and businesses will qualify for commercial rates of SDLT, which are much lower than residential rates, and it will be on a case-by-case basis to assess the tax consequences in each particular instance. To great relief, the budget did not change the lifetime gifting rules. There's been no change to the 7-year rules. They still apply. Again, this is something that individuals can consider, gifting assets out of their estate and surviving 7 years. They can also, if you've got a family business, a company, for example, you can consider freezer shares where the parents' shareholding is frozen at today's value, and they create a different class of share called a growth share, which they give to their children, which in the future will represent the increase in value of the company over time. It mitigates inheritance tax. It doesn't reduce it or eliminate it. It's not usually an IHT event because you're giving something away that has no value at the point where you're gifting the shares to your children. And it's not generally a capital gains tax event because the shares have no value at the point of the gift because it's future value that's contained within them. Obviously, you have to compare this with the now higher rates on dividend income, which from April 2027 will become 8.75% and increase to 10.75% on basic rate, and from 33.75 to 35.75 on higher rates. This will very much depend your decision on whether you're looking for capital growth and you're not taking dividends out, or whether you intend to take dividends out. But compare that with the personal rates for basic rate, of which are going to be 22%, and for higher rate, which are going to be 44%. So the rates are still quite favourable. If you're considering incorporation of your business, then incorporation relief will defer capital gains tax if it's an active business that's transferred, which is a wider definition than trading. Landlords seem to have been quite unpopular over the last few budgets. There was originally the 20% cap on mortgage relief, which was announced in the 2015 budget and phased in over April 2017 to 2020. This budget has put higher rates on rental income from April 2027, adding an extra 2%. I think what you plan to do will depend on whether you have a mortgage. If you incorporate, you'll have SDLT to pay and potentially capital gains tax if you are not of a trading nature. So you might want to consider purchasing your properties through a company in the first place. Jade, from your perspective, what do you think people can do to mitigate the impact of this budget?
Thank you, Ingrid. And I think there's just so much to digest in terms of the various changes that are coming in, each incremental in their own right. But depending on which category you sit in, the combination can be quite a lot to consider. Now, you have touched there on landlords, so I'm going to pick up on that first. When we look from a financial planning angle at the various investment choices that individuals and indeed companies make, I think the latest budget announcement regarding the mansion tax that Graham mentioned earlier is going to be, to some extent, another nail in the coffin for landlords and investment properties. So I think individuals really need to think carefully about the spread of investments that they have when it comes to looking to achieve growth and income, and ultimately how that can be most tax efficient. Diversification is key here. And I think with the progressive changes that we've seen in both the limits to income tax and other tax being frozen for longer, having a variety of tax wrappers is going to be key to ensure you're maximizing that tax efficiency. So, whereas perhaps 10, 12 years ago, individuals may have been saving diligently into ISAs, building up a portfolio of investments which were generating a dividend income, perhaps investing into investment properties and becoming a landlord for the first or second or third time. I think now we need to look at the restrictions on those allowances that individuals can use. And for me, with the continued limit on the dividend allowance at such a small amount now, I think we may well see a return to some other investment tax wrappers, such as investment bonds, which for some individuals might be an appropriate step where they are looking at being one type of taxpayer today, particularly if they are still working and earning taxable income, but where they anticipate being a lower rate taxpayer in retirement. There are some benefits to investment bonds in that regard. However, the best use of the variety of tax wrappers that we have here within the UK is really to try and have one of each of them, almost collect them like a series of collectibles by the time at which you want to be generating growth and income from them. Because having that spread of the variety of tax wrappers is going to give you options. And as we see at each budget, there seems to be some tinkering to allowances, to thresholds, to tax rate. Having all your eggs in one basket, be that investment properties, be that ISAs, be that pensions, it does create some challenges if there are significant changes made to that particular type of investment vehicle. So we're really encouraging people, not just because of the significant changes to pensions and inheritance tax, but more broadly the position with regards to fiscal drag on the limits to taxation. We're encouraging individuals to go back to the drawing board, consider what you have today and ultimately what you're looking to invest for in the future, and just ensure that you have that spread of investment vehicles available to you. The other area I think it's worth touching on, just because there's such a short time frame in which to do something about it, is that we have VCTs, so venture capital trusts, which were announced within the budget for the income tax relief to be reduced back to 20%, which indeed is what it was a number of years ago before the relief was increased to 30%. But again, this doesn't come in until April 2026. So theoretically, we do have a short window in which individuals could consider an investment into a VCT. Now, these typically are high-risk investments. They are only suitable for a small number of individuals. But if there are people out there who have made VCT investments previously and are looking to do it again, it may be worth doing it sooner rather than later to try and capitalise on the 30% income tax relief as opposed to 20% that it's reducing to in April 2026. And the final thing I will end with is checking tax returns. So we know that because of the fiscal drag that we've all talked about on this session, there are more and more people being brought into needing to complete tax returns and paying tax. Whereas before, allowances, be it personal allowances, dividend allowances, covered the income or perhaps the savings interest that was generated. Because portfolios are rising and thresholds are remaining where they are, more and more people are finding that they're needing to pay tax on the interest, dividends, or capital gains that they are generating within a given tax year. And where they haven't done this before, it's particularly important to make sure you're speaking to professionals early. You don't want to be caught out with any penalties or late filing fees. So making sure you're checking those tax returns, ensuring that they're accurate, and getting help as soon as you can.
Thank you, Jade. That's really informative. Danielle, what do you think of the negative aspects of the budget?
Thank you very much, Ingrid. I have to say, the negative impact from the budget has been on the middle class. As all of you have just alluded to, it's hit them much harder than most, and with the focus specifically being on the property sector and landlords. That's where we've seen lots of changes, and it will have an impact on their cash flow going forward. One thing that I noticed in the details, it wasn't actually mentioned in the budget, but I thought it was worth mentioning here. So hidden within the document were references to the changes to the starting rate savings limit. So the government said they're going to introduce legislation from the 25 Finance Bill referring to the savings limit of £5,000. Now, we've known that for years, so that's not really changed. However, the devil being in the detail, it alludes to allowing individuals with less than £17,570 in employment or pensions income to receive up to £5,000 of savings income tax-free. Now, the fact that it doesn't mention property income, does that mean those that are receiving property income are not going to be receiving the £5,000 starting rate band? Who knows? The devil is always in the detail. Much more is going to come out, but it just shows that what we see in the headlines is not always what's happening underneath. And so having that professional advice in terms of planning going ahead is most important. So I thought, while we're talking about the impact, what does it mean for cash flow? Let's cover some of the areas which people are going to start seeing changes coming forward. The first one I want to mention, because it is a significant change, is that from April 2029, income tax for self-assessment taxpayers with pay-as-you-earn income, they're going to pay more via their self-assessment liabilities via pay-as-you-earn. It is worth noting here, though, that there is the pay-as-you-earn regulation caps, meaning that pay-as-you-earn deduction can only be up to 50%. So there's still going to be an element of tax potentially that's not going to be collected through pay-as-you-earn and will still be due on the 31st of Jan following the tax year end. So the government's going to publish some consultations in early 2026 on delivering this change and just encouraging timelier tax payments. It's going to also cover those that only have self-assessment income. But one of the things you should also look at is those for business owners that have VAT and pay-as-you-earn liabilities. We know that they are always paid on a much earlier time span to what we're used to with self-assessment. However, they are going to be looking at ways of how to collect this sooner. I think that's probably going to be maybe by way of direct debit, just to stop people potentially needing to get time to pay arrangements and delaying those payments. We've all been hearing making tax digital. I think we've all heard it far too much, but what we always knew was the intention would be, with the filings coming sooner, that they'll be asking for the payments to be coming sooner as well. And so we are actually seeing this happen on the back of the budget. Each of you have mentioned the freezing of thresholds, so I'm not going to mention that again. However, with the additional 2% tax on property savings and dividends, it is worth just mentioning that they've not added the 2% to the additional rate on dividends. So I think that's welcome relief to some higher earners there. One of the things that I looked at though, and I've seen lots of modelling in terms of what does it mean with the dividend increase of 2%. What does it look at for those that are actually trading through limited companies versus self-employment? And on the modelling that I've seen at each level of income, it's now more advantageous to be trading through as a self-employed individual if they normally take a small salary up to the NIC threshold and take the rest as dividend income. So it's one of those things that actually planning, have a look, is the structure still fit for purpose? Do they need to be looking at ways of changing how they're going to be receiving the money out of the entity? I'm not saying one size fits all and go away and do it. Please take professional advice, do the planning, do the math, and just actually see, should the profit extraction be taken in a different way? Jade's alluded to pensions, and obviously those changes are going to come in a couple of years' time. So actually taking some action now and seeing what that looks like is really, really going to be helpful for lots of people. I did want to mention something that Jade said because it is really important. People within self-assessment, it's fine. They're filing their tax returns and so everything should be up to date. But what we do see is lots of people who haven't been filing self-assessment returns in the past and know what the rules used to be. And as we know, they are changing so frequently that they could get caught. In terms of the penalties, failing to notify penalties are very high. And what I would say is actually asking an advisor to see whether they do fall within the tax net, because what you don't want to do is leave it a few years and have actually accrued lots of penalties that you didn't know about. Last thing that I thought I'd mention, and there was lots of changes here, was actually on closing the tax gap. We've all heard lots and lots of figures bandied around. Lots of changes and measures have been announced in the budget and they're going to be coming in over the few years. A couple of them that actually caught my eye and I thought I'd mention today: loan charge. Hopefully none of you that are listening to this podcast are called by the loan charge, but we know that there are still lots of people out there that didn't settle with HMRC. Lots and lots of information came out on this budget on changes that are going to be coming in. This is going to be the last opportunity. They have said that. But what we have seen is favourable terms being available. It's a huge shift in the approach. It's something that's unprecedented. We've not seen it before. So if the loan charge applies to you and you haven't settled, please expect to get a letter from HMRC early next year, probably springtime. As I said, terms are unprecedented. So if you receive a letter, seek professional advice and act within the limits and time limits that they're setting. A couple of other points just to cover off are rogue directors. The revenue have seen high levels of insolvency and those that are actually abusing a solvency to actually get debts written off. And so what the government are going to be doing is investing 25 million over the coming years just to recruit and address the issue. So that's a real welcome change to see coming through. And the last point I wanted to mention was the rewarding of informants. It was something that was announced last year, but they've mentioned it again in this year's budget in terms of modelling on the US scheme. So it is one to see how is that going to be working and what impact we're going to be seeing. But all I can say is there's going to be lots and lots more compliance activity from HMRC over the coming years.
Thank you, Danielle. That was really interesting. Graham, are there any changes in the budget that affect the non-dom regime?
Yes, there are. Very few, but they are potentially have been seen by a few people as an olive branch to those non-doms who, after the October 2024 budget, left the UK, albeit maybe temporarily, and thinking potentially about coming back. So we now have the change to the way in which inheritance tax would be collected, or the amount of inheritance tax to be collected on what were excluded property trusts using the old language. So trusts that had been created before 30 October 2024 that were previously, up until April 2025, outside the scope of inheritance tax. If you were then still in the UK and a long-term resident, so been here for at least 10 years, the new rules provided that your trust outside the UK, which was previously excluded, would pay inheritance tax of up to 6% once every 10 years. HMRC have said that they're going to cap the amount of tax being collected this way to 5 million. So if you have a trust that has effectively more than about 86 to 90 million in it, then that might be of interest to you. And it was a bit surprising. Go back to my previous comment, there was a surprising winner. So that was one that I don't think any professional was expecting to see in the budget. However, just generally for res non-dom clients, I'd flag up two things. One is for those that have been here for a while, is still the temporary repatriation facility is something that they should be considering. So if they have income and or gains that have been untaxed in the UK because they've claimed a remittance basis, still a good time to remit that. You've got 12% for the remainder of this tax year and next tax year, and then rising to 15% for the following tax year. So reviewing previously unremitted income and gains is something they should do. And also for those individuals who have arrived more recently, the new FIG regime, foreign income and gains regime, is still attractive. So for the first 4 years that you're here, that you wouldn't be taxed on foreign income and gains, regardless of whether you remitted that or not. So that's more positive. But from the start of year 5, you would be. So there's always a window in there for individuals who think they are going to stay longer than 4 years. So previously, what we described as resident non-individuals that thought they were going to stay for longer than 4 years should really be doing some planning around that. So, as I say, surprising development, certainly on the trust side, and there are still some good opportunities for newly arriving and non-doms, as I will still call them, and individuals that have arrived more recently as well.
Thank you, Graham. At least it's only once a year. It's either potentially bringing a bit more stability, or the question is this a stepping stone for more tax rises next year? To wrap up, I'd just like to go around my guests and to ask them, what's your single takeaway that you'd like people to think about? Graham?
I agree with your comment. I think I very much view this as an interim budget. We still need to deal with, as I mentioned at the start of some of my earlier comments, the national debt and how we deal with the interest on that. So at the moment, 1 pence out of every 10 pence that's raised by the government, or 10 pence in every £1 is expended on paying the interest on the national debt. So that is something post-COVID that just really does need to be sorted out, and the Chancellor is going to need to pull some pretty big levers. So at the moment, I think it's steady as she goes, but let's see in later budgets what the Chancellor is going to do. So that was my takeaway, Ingrid.
Thank you. Jade?
So for me, it's back to basics, Ingrid. Review what you have got, what you're trying to achieve, and ensure that in light of the changes that are effectively staggered over the next 4+ years, you're set up for what you want to achieve. So get in touch with your professionals and ensure that you know what your plan is and how this budget changes those.
Danielle?
From my perspective, I just think it's just reinforcing that HMRC compliance activity is going to increase. They need to get more money into the bag, and the way they're going to be doing is actually tackling that abuse and boundary pushing. And so we are going to see lots more happening in that space.
Yes, I agree. People need to go and see all of their advisors and take a view. Well, thank you everybody for joining this episode. It's been very enjoyable meeting you, Jade, Graham and Danielle, yet again, and hopefully we can do this next year as well. Well, from all at DMH Salad, thank you for joining us, and we look forward to being with you during our next episode. Thank you. Bye-bye.